joins us, then we'll just go ahead and let them in. But I appreciate your time, Tristan, and Harry's time. I appreciate you both being here. And collaboration is really our middle name at Innovate Springfield. So we're excited to partner with Justine Petersen to talk about their credit building opportunities. And I'm just going to pass the mic to Tristan to introduce himself and the work that they're doing. So thank you so much, Tristan.
So my name is Tristan Brown. I'm an asset building counselor with Justine Petersen. And really what I do here in Springfield is my main expertise is doing small business loans for the local businesses, especially on the east side. That's our main demographic that we're looking for right now. But we also we have a ton of products, credit building, save to build, and I'm going to go through those in my little presentation. I'm going to share my screen real quick as well. Okay. Can you guys see this?
Yes, I can.
Okay. So what is a credit score? Well, I put the definition, the actual definition is a number assigned to a person that indicates to lenders their capacity to repay a loan. Well, my definition is pretty much the same thing. A score from a systems algorithm taking into account past payment history and debt responsibilities. And I will go into more deep into what all goes into the algorithms of the different FICO and experience scores. Why is credit important? Your overall report can be one of the things standing between you and owning assets, real estate, vehicles, and really, especially people who have the money who pay in cash, don't think about that moving forward in life. You never know whenever you're going to need a loan, especially going in for a car loan or even going, like I said, going in for a mortgage is really important. We try to build up that overall score and get it up to a 640 is our golden score, is what we're looking for before we send a client to apply for a mortgage. And then it also determines premiums on your car insurance. I mean, I've seen clients with poor credit with their premiums are $1,000 every 6 months. That's insane. So it will tremendously lower that amount. Determines if you are approved for rental housing. I mean, it doesn't have as much of an effect on if you have poor credit, but if you have super low credit, you can be refused for your rental applications. And then it really just determines overall financial freedom. Say an unaccounted for cost comes up that you cannot pay out of pocket. If you have a credit limit of $5,000 to $10,000 right there. And that's not the best way to handle it, obviously, but at least you have something to fall back on. And I'm going to go over the different types of the main types of credit lines that I usually see on a credit report. So what is a revolving account? A revolving account is a credit card line that is continuously revolving interest with no end date, which is basically a credit card. And whenever a credit card balance is over 90 plus days of delinquencies, most credit card companies will let you go 120 plus days of delinquency before a total charge off, but they will charge off the account and put it in collection status. And now, whenever it goes into collection status, your best bet is to pay it off immediately. Now that collection status will stay on your credit report no matter what. If you do not end up doing a pay and delete, which I will go over what a pay and delete is later on. But it will not fall off for 7 years. So say you do have a credit card charged off from 2015 and you pay it off recently, though, it goes from the last transaction. So that comes to my next point. If you have an old charge off from the past, and it's been almost 7 years, you're better off just letting that fall off of your credit than reopening the account and the transaction history on that, because it's all based on the last transaction. And a charge off is whenever a bank actually writes it off as a loss on the balance sheet. And that's why they go after your credit as well, because it's an unsecured credit line. So they have nothing to repossess, nothing to foreclose on. So that is their only way of kind of getting back at you for adding to their loss sheet for that year. And what is an installment account? Now, this will be different than a revolving account because an installment account technically has an end to it. So it's a predetermined amount of time that you're going to be paying off the loan. Now, whenever it comes, and I know I have student loans in there, whenever it comes to student loans, that's a little trickier because you are supposed to have it paid off in a certain amount of time, but if you miss a payment, it'll just keep. So it's kind of like revolving, but it will never go away. Student loans never go away, no matter what. And you can, they will go in collection status, but they will never go away. And there are programs out there. There are some bankruptcies you can get them taken off your credit report eventually, maybe, but I haven't seen it. And I've only heard of several doing that. So, but an installment account is a line of credit with a set number of payments over a time, usually a consumer loan for a vehicle, mortgages, student loans, like I said. After being 90+ days in delinquency status, these turn into collections rather than charge-offs. And it is a collection because they're actually collecting something from you because it is a secured account. So they are repossessing a vehicle, foreclosing on your house. Student loans, they don't repossess anything, but they just never go away. That's how they continue with that. And I wanted to go over just several different types of the most common bankruptcies that we see because there are many out there. So Chapter 7 and Chapter 13 are the most common though. So Chapter 7 is, it will stay on your credit report for the next 10 years. Now, you can reaffirm on what you would like to retain. So a Chapter 7 is whenever you liquidate all of your debt, no matter what. So you're giving up your vehicle, you're letting them foreclose on your house. And you're taking all of the equity from that, trying to pay back all of your debt that you have attained to this point in your life. And so technically you're paying it off, but you're paying it off by giving up everything that the debt helps you pay for. And usually you come out on the other end with more debt, and that is where the bankruptcy wipes it clean. So it pretty much just takes the difference of the equity from everything that you own and wipes that clean. Now, Chapter 13, whenever you file it, it only stays on your credit report for 7 years. And because you're paying it back over a 3 to 5 year payment plan that is decided between you and a judge. And whenever it comes to bankruptcies, actually both need to be discharged by a judge. You need a judge's permission to be able to do bankruptcy. Now you can file bankruptcy, but it doesn't mean it's going to go through. And even if you file bankruptcy, it's going to stay on your credit report for at least 7 years. All right, so this is the main page that I wanted to go over for the credit do's and don'ts that most people, I mean, most of it is basic knowledge, but a lot of people don't know it. So on-time payment history, super key for good credit. Checking monthly credit standing, super big for great credit. Because you know how many clients that I've had that don't keep track of their credit and have a small amount on a credit card going delinquent. I had a client once having a $15 balance that went 90+ days over delinquencies because they just didn't check it and they thought it was paid off. And eventually we were able to get a pay and delete on that, where we contacted the credit card company, explained the situation. And since the credit card had recently been opened in the last 6 months, they allowed us to just pay off the remaining balance and close it like it was never opened. So it didn't affect the client's score in a negative or positive way, which is good because it would have affected it tremendously negative. And then, I'm sorry. Okay. And then another credit due, apply for a limited amount of credit cards within a certain time frame. And I know I have on the right side, apply for one of the don'ts is apply for more than 5 credit lines with it. And so that's usually the gray area where I like to keep my clients between 1 and 5 credit lines. And that's credit lines, not credit cards. So say you go and get a vehicle in May, and then you go and open up a credit card in June, and then you go and get a mortgage in July. Well, every time you get your credit pulled and every time a new account comes onto your credit, it's going to lower your score. And funny enough, no matter what it is, if it's a new credit line, it will lower your score because there is not enough transactional history for it to improve your score at the time. Now, say you make 2 to 3 on-time payments, your score is going to go back up to what it originally was, and maybe even more, depending on your other account's payment history as well. All of it is based off of payment history, how long you've been paying on it, and just how long you've been paying on it, I guess. And then so one of the do's I always recommend as well is get your balance down to 0 on store-bought credit cards. So I know that it's really beneficial in the time whenever you get that 15% off or whatever at the register whenever you sign up for a credit card. But as soon as you do that, they're going to pull your credit, which lowers your score. And that interest rate is the lowest one I've seen is 19%. So it's going to kill you over the next 3 months if you don't pay it off on time or keep using it at other entities. And I see that all the time as well. Pay off current debt balance to 0. That's an obvious one. And then settle collection balances, pay and delete. So settling collection balances is a huge one. Say you have several large collections and it's been several years, you can contact the collection agency or the company that you have the collection from and see if they will settle for, most companies will actually settle at around 55% if it's been a long enough time, 2 to 3, and now I'm talking 2 to 3 years. Say you just went into collection 3 months ago, they're most likely not going to settle for that amount of less of an amount. So just keep that in mind. There's a lot of variables that go into it, but it really does help the overall score, especially if you can settle and get the pay and delete. So a settlement and a pay and delete are 2 separate things. Say you settle, but they don't pay and delete, it'll still show up on your credit report as a paid collection for the next 7 years. And like I said, even though it's already been 3 years since we recently paid, it goes off of your last transactional history. So you recently paid off the full account, it's another you're waiting another 7 years for that collection to fall off. But it does show up as a paid collection, and mainstream financing will see that and most of the time not counted against you. Now in the pay and delete instance, it's going to not only settle the collection, pay it off to a 0 balance, but take it off your credit report as if it never existed. And in some cases, say you only have 1 large collection and they're able to do that, this I've seen boost credit scores 40 points in 1 move. So it's just really valuable information and really something to look into if you're bogged down by old collection debt. And then opening a secured credit card with a low balance is also a do. So, and I usually advise this whenever someone doesn't have a lot of credit history or doesn't have an active trade line on their account. They can reach out to Chime. I think Chase has one, Justine Petersen offers one, to where you send in $300, you send in a $300 check, get it taken out of your account, and they will send you a card. And it's secured by that $300. So they're taking no risk on giving you that card. So say you get the card and you run it up to $299 and then don't make any payments on it, then they'll just take the $300 out of that account and close the credit card. So, and it's still a revolving account in the sense of you send in $300, they give you the card, you run it up to $299 and then you pay off that $299 in the month while you still have that $300 limit. So it acts as a revolving account and a secured credit card, which it is a great and useful tool if you're trying to build overall score in the long term as well. And then become an authorized user. That is a huge one. So say you have a parent or a friend that you really, really trust, or that they really, really trust you, I guess. Just ask, say, hey, can I become an authorized user on one of your credit lines? And what will happen is that they'll add you. It's pretty simple to add. It's usually through an app, or they'll go online, fill out a form, and they will send a second credit card. Now, in my advice, it's always best to just cut up the second credit card. There's no use for it. And let that individual use that credit card as they normally would. Like, say there is good payment history on it and everything, that can boost your credit score up 30 points right there as well, because you are inheriting all of the recent payment history that has been made on that card. So say you have a parent and they have a 15-year history on a credit card and they add you as an authorized user, technically you take on that 15 years of use. So that's also a fantastic tool to really boost your overall credit score as fast as possible. Now, some of the don'ts, I've already went over some of this. Apply for 5 credit lines within a year, and inquiries will really kill a score. I've seen multiple people. Another good example of this is whenever you go and apply for a vehicle loan and say you don't have a pre-approval and you just apply through the dealership. Well, they're sending out your credit info to 4 or 5 different entities at that time. So that's 4 or 5 credit pulls right there. And there you've reached your limit on what I advise on how many times your credit should be pulled in a year. So I would always go in with a pre-approval, or at least let them know, like, hey, this is my bank, or these 2 banks are what I'm looking for to get my loan from. I only want my credit to be sent to those banks. That's usually the best way around it. Or even another option is freezing your credit score and or freezing your credit report to where it cannot be pulled unless you call ahead of time and give your authorization on that. And then another don't, keeping unpaid collections. But like we said earlier, if it's been almost 7 years, they're going to fall off, and it's almost not worth reopening an account or reopening that transaction history if it's going to fall off in the next couple of years. Now, whenever it comes to unpaid collections as well, what can really happen is, say you've had a collection for 4 years, it was an auto loan, say they repossessed an auto loan from you, or an automobile from you, and that bank has kept that collection for these past 4 years. Well, they could sell it to a collection agency. Now, whenever that collection agency takes on the responsibility, that 7 years gets rebooted. So that's always something to keep in mind too. There's just so many variables that can go into it. And my best advice is, if you have the money, to always pay it off if it's within the time frame that we've been speaking of. And then another don't is filing bankruptcies. I usually advise against bankruptcies unless you really have to, just because even if it's dismissed, it will stay on your credit report for the next at least 7 years. And then refinancing more than once on the same loan. That's another don't that I say. So unless it's a mortgage, with mortgages, that's totally fine. We've seen 2, even 4 refinances throughout the years. I mean, if you can get a better rate on your mortgage, I say go for it. And if you're willing to do all the paperwork that goes through that. But whenever it comes with auto loans, that's a big red flag as well. Whenever it comes to mainstream financing, say you've refinanced your vehicle 3 times, your previous vehicle loan 3 times. And I mean, obviously, if you have great payment history on it, it's going to help you out. But most of the time, if you're refinancing your vehicle that many times, you don't have very good payment history on it. And it's just a big red flag to the next financial institution that will be handing out that next consumer automobile loan. And then payday loans is another big don't of mine, which I realize that they're out there for a reason. People need loans, right? Or people need money right away. And everyone's in a different situation, and I do understand that, but I really, really heavily advise against it, because the term on that is usually around 7 days. And if you don't get those paid back in the next 7 days, that interest rate is at 40, 50% sometimes. So, and I've just seen payday loans get out of control before. And they're still on the credit report active months after taking them out. And it's just a big don't in my advisement. But if you really have to, and there's no income coming in anywhere else, I mean, it's a great service for you, I guess. And like we spoke about earlier, signing up for store credit cards, Walmart, Kohl's, Nordstrom racks, any of those are a big don't in my book, because there's such high interest rates. And I see a lot of people open them for, well, if you really think about it, it's high interest rates and an inquiry on your credit report. And it's bringing down your overall credit score, just because it's a new active account that you don't have history on. So it really just adds it to the algorithm, and really will, it just isn't beneficial in any way. And then a big don't is close accounts that have been established more than 3 years with good payment history. So say someone has multiple credit cards, let's say 5 or 7 credit cards, and they're just looking to get rid of one. I would advise them, if they're looking to get rid of one and all the balances are 0, to close the one that was open the most recently, just so we don't lose that payment history. All right, and then I wanted to go over who Justine Petersen is, what we do, and what my specialties usually are. So who is Justine Petersen? Well, Justine Petersen was, social worker, sorry. That was really, she was a social worker through the 80s and 90s, and also worked in mainstream financing, and really just noticed that there was a gap that needed to be bridged between people who couldn't find mainstream financing and just didn't really have what mainstream financing was looking for, like the credit score requirements and all of that. So what do we do? Well, we do what mainstream financing can't. We try to say yes, no matter what. So mainstream financing will only look at a credit report, only look at credit score. We take into account the monthly income, the yearly income. We also take into account credit score, payment history, what your collection status is. And I will say that just our demographic compared to mainstream financing is so much different, that we are able to do a lot more than what they're able to do with their types of regulations and our types of regulations. We are a CDFI, Community Developmental Financial Institution. And overall, what our goal is to get people to the next step. Our goal is to get people to mainstream financing, get their credit scores up high enough to get a normal financing bank's loan. What home ownership is really a huge thing that we are looking for. And whenever it comes to credit building and credit counseling, that's usually one of the first questions I ask to a client. What is your end goal? Is it just to raise your credit score? Is it just, is it to own a home? Is it to own a vehicle? Is it to have good business standing and credit moving forward? And there are a lot of just different variables and different things that we can do to reach and attain each of those goals. So, and what have we done up to this point? Well, we've dispersed over, I want to say, especially in the past 2 years, we've dispersed over $10 million, especially the demographics that need it. 55% female demographic, 52% Black entrepreneurs, and just moving forward, we really are trying to develop and or do economic development within each state that we're located in. And right now we're located in Missouri and Illinois. And why you should care? Well, you should care because we recently expanded back out to Springfield. Like I said, we're in Illinois, and the city actually just did a buy down rate. So our SBA loans usually go around 8.75 interest rate. And recently the city did a buy down on the rate to make it 3% no matter what, if you have a Springfield address. So, and if it goes for a business loan. So that's why especially locals should care, and especially entrepreneurs in the area. And I will go over what we're looking for next in our loan products. So these are the loan products that I specialize in. Our SBA micro enterprise loan, and it does cap out at the 50,000. JP average is just under 10,000. So I will say the different levels of it too. So we'll go up to 3,000, 5,000 max with approval from the board for uncollateralized loans. So that's not using a vehicle, not using real estate, just an unsecured amount of money going towards your business. And that is, for the term on that, it's usually around 36%. And with the 3% rate on that, the monthly payment is around $90, I want to say, 95. And like it says here, up to $3,000 on unsecured loans. Anything above that, up to 20,000, we usually require some sort of vehicle. And some people, like say you have multiple vehicles that's an 04 and an 06, and they value out to $15,600. Well, we would be able to do the loan for $15,000 most likely. So that's how that would work. And then anything above 20,000, we usually require some sort of real estate, equity in real estate, home. And we usually require at least 20% equity. It all depends on what loan amount you're looking for, I guess. And I wanted to go over as well that say you only have $25,000 in equity in your home, that we would only be able to go up to probably $24,000 on that. And a lot of people are just misinformed or just don't really understand on how the loan amount is, how we come up with the loan amount on that and what our max is whenever it comes to the collateral. But say the collateral values out at $300,000, I mean, and you have 20% equity, we can do the 50,000. So
can I ask quickly, Tristan,
yeah.
What is the success rate of the loans in the payback
rate?
Correct.
It's in the 80%. I don't know the exact amount, but it is, we have at least an 80% success rate on paybacks.
And so can you give us a little context about that compared to the traditional opportunities? Is that like a really high figure?
Yes, it is. So usually, especially with banks, they have a system where they can get bailed out if they lose a whole bunch of money that they lend out. So they have less, I mean, I would say the average bank is within the 50%. And we always try to find the best payment amount that works for you. We always say someone does come back and needs a restructure plan, we will restructure up to 3 times for an individual to make sure that they're able to make that monthly payment and be successful moving forward.
That's interesting. That's helpful. Thank you so much.
Yes, absolutely. I mean, we try to take everything into account. That's why, I mean, part of the process is we make you, if your credit score is low enough, we will make you do a credit building session with us. We will go through a monthly budget with you. We will do everything to set up for success moving forward in the future. And so I also wanted to go through our CDFI microloan as well. Same sort of, it caps out at 50,000, but this is offered by our Great Rivers Community Capital CDFI loan fund. And this is typically over the $10,000 mark, but we also offer consumer loans from this fund that doesn't need to pertain to a business, that will still be between the interest rate of 12 and 20%, just to keep in mind. But it's also a good tool for people that can't find mainstream financing, that don't have a business, that need some sort of funding right then and there. So it's just something to keep in mind, and it's usually unsecured whenever we do the consumer loan, but we can do a secured consumer loan as well. Now, whenever it is unsecured, we will only go up to 2,500 on the consumer loans instead of the 3,000, because it's helping an individual and not a business. But the main difference, I will say, the main difference between the SBA and the CDFI microloan are the interest rates. If you look at the interest rates, 7.25 to 11%, not terrible, but whenever you come over here, 12 to 20%, and I will say that is pretty high. But whenever you're dealing, and you have to look at the risk that the lender is taking. So whenever you look at our clients, I will say most of them fall under the high risk category if you're looking at just credit scores. So, and that's what that is based off of. And I know both of these also say up to 72-month terms, but we actually just recently changed that as well to an 84-month term. So, and that's also depending on the loan amount. So say you get a $3,000 loan, I would most likely not stretch that out to 84 months. I mean, it's within reason, obviously, but say, I mean, anything past 10,000, I believe can be pushed out to that 84-month term to try to make the payment reasonable and affordable. And like I said, we try to work with the client as much as possible and take into account anything that has happened to them within the past year, especially with COVID. And I know it says 100% collateral requirement, but that's not always the case as well whenever it comes to our $2,500 consumer loans. And the closing fees also differ here. So this is a 3% closing fee, and this one's a 6% closing fee. So the GRCC is definitely the higher interest, the worst funding that you could get, I guess, that we offer. But it's just because the SBA comes in and helps us with the lending, and they do a buy down on the rate as well, which is why we're able to offer such a lower interest rate. And then whenever it comes to our credit building counseling, we offer a secured credit card, like I said earlier, and I explained that, and then a save to build program. So that is the same concept as the secured credit card. You will be doing a secured credit card with it, but you also continue to send in money, and it helps. And I'm not very well versed on it, but the basic is you send in money and we keep that money in an account for you per month. And at the end of the year, you're able to take it out because it has grown interest throughout it teaches people how to budget and save, I guess. And I do need to verse myself more in the Save to Build program. It's just not a specialty of mine. And we have actual credit building counselors that deal with most of the credit building clients. And monthly follow-ups though, every time that I do have a credit building client that just comes to me for credit building, I try to call them at least once a month. And most of the time more than that, mostly twice a month, just to see if we're on the same game plan and see if we need to tweak anything, what's working out, what's not, and just what our game plan is moving forward. And I usually try to set up, whenever I have my credit building meetings, I usually try to set up a year's length worth of goals that I want them to hit each month. And that's why I do the monthly follow-up. And then this is where I wanted to do the question and answer for people who had any questions. So.
Thank you so much, Tristan. Harry, did you have any questions for Tristan?
I've got some difficult questions for Tristan.
Yeah, for sure.
Okay, so why would I want to come to Justine Petersen for a loan at 7.5% when I could go directly to the SBA for 3%?
And that's exactly, so if you're able to do that, if you're able to meet their requirements, then we advise that. We advise people to go to mainstream financing or any other, we're kind of like a last resort for people type thing. So and that's why we're here. I mean, we're here for a client base that can't find funding anywhere else, that is usually considered as high risk for mainstream financing, and they have nowhere else to go. And they would like to start a startup company. They would like to start up a business. And the difference is too, most mainstream financing won't fund a startup company. You have to show being established a certain amount. So.
Yeah. Okay. And a couple follow-ups to that. Mm-hmm. Does Justine Petersen do any type of VC, or is it VC, venture capital?
Oh,
you trade money for stock, essentially.
Oh no, we do not. Yeah.
Not that Midwest Chemical Safety is a corporation that has, stock. We don't. We're an LLC.
Yeah.
And one other thing is, you never mentioned how financing affects Dun & Bradstreet scores.
You mean Duns and Brad? You said Duns?
Dun & Bradstreet, yeah.
Okay, yeah. So we report to both, actually. So we'll report to Business Bureau and the Credit Bureau, as long as you provide the DUNS number. So.
Okay.
Yeah. And the reason why I usually don't go over that is because most of our clients too aren't that established yet to where they have a DUNS number to be worried about or filed for it yet. Like I'm working with a lot of people as well that are just now currently working on their LLCs, and they had just gotten their EIN. So.
Those are really great questions, Harry. Thank you.
Well, I've been in this space for a while.
Yeah. Well, and I have a question too, because I've encountered young people or, people maybe on the fringe of the population we're talking about who don't have bank accounts, and they cash their paychecks at like a Walmart, who then take a percentage off the top. So where would you suggest someone go to start their first bank account?
Now, that is a big question, because I will say we have denied people before because we require 3 months of personal bank statements. So you need some sort of bank account showing that there's some sort of cash going in and out. And so my advisement on that is to just start a bank account where you feel the most comfortable, I guess, where you feel and what works out for you locally. And what would work best for you. And I'm not talking business bank accounts. Is that what you were talking about?
No, right. Like just a personal bank account, right? Like we're just knowing this population and they don't know what they don't know. And I feel like then too, I've seen individuals, get taken advantage of by a big bank. I guess I can name names, Chase Bank, where they'll set up an account that requires a minimum balance in your checking account, and then they charge you if you don't maintain that minimum balance. And this is a vulnerable population who's living paycheck to paycheck. So, we can't afford it. So
Yeah.
We have always suggested that folks pursue a local bank, especially in the COVID age. We found that people who had a relationship with their banker at a local institution fared better. That's why I was just curious about, your
Well,
perspective on that.
I agree with you. Find a local bank, like I said, and something that you feel comfortable with, and that and that you feel like that they're not going to take advantage of you. And I know, I assume that people at Chase felt the same way, but in my experience too, the smaller banks usually don't. So.
Thank you. I appreciate that.
Mm-hmm.
Harry, did you have any other questions for Tristan while we've got him?
No, not right off the bat. It was a great presentation.
Thank
Yeah,
you.
it really was. It was very informative. I learned some things, some takeaways too. So I appreciate your time. And I think that there is a need in our space, especially for the early age starters that we serve, to have this kind of credit counseling and opportunity. So I'll definitely, share this recording on our YouTube channel, and anyone who comes to our door, we'll connect them to you, but perhaps we can long-term think about collaboration or office hours or something like that.
Yeah, fantastic. And then will you shoot me a link to the YouTube video whenever you upload it too?
Absolutely, I will. You got it.
Thank you.
Yeah, I appreciate you both participating in your engagement. Thank you for showing up today.
Yeah, thank you for showing up, Harry, and for your questions. You've been awesome too.
Well, like I said, I've been in the space for a while, so although like the presentation didn't resonate with me specifically, it may resonate with some other people, and to ask those fundamental questions. I know that the EIDL that came out, that was like pulling teeth, but once I pulled the tooth, the floodgate opened.
Yeah.
Yeah.
And we actually use the EIDL policy mapping as well for our loans for the SBA. So whenever it comes to the distressed areas, and that's how we make our decisions for loans above 20,000. If it's going to be able to go GRCC or the SBA at the lower interest rate, because it's based off of the idle mapping system.
Yeah. Well, one of the things is that, and I want to clue you in on that just a touch, is I maintain an address here at Innovate Springfield, but my normal company mailing address is in Dawson, so they're both in Sangamon County. Well, my EIDL targeted advance was denied because of my Dawson address, and now let's say that I was displeased.
Yeah.
Because I do have a space address here in Springfield. I appealed it. They said it was denied again. So I'm having my Congress critter.
That's very interesting. So they said, so they were using your business address in Dawson, and that's not in the mapping
how 10 miles in a 10 miles difference.
Yeah.
And I'm out in the middle of nowhere.
Yeah.
I'm in the middle of farm country. They said that didn't count, and you're denied.
Yeah.
I was less than pleased.
Yeah.
So, like I said,
and the way that, from what I see, the way that works though is it's just all they base it off of economic distressed areas, and I bet since you're just 10 minutes that way, you're just right outside of it.
Oh yeah, and it's based on, it's also zip code. So
yeah. Oh yeah.
Yeah. So we'll see what happens. The last time I had to get my Congress critter involved, it fared well. And I'm a big believer in is if you never ask, the answer is always going to be no.
That's true.
So the worst they can tell me is no. Well, they already did that. So I'm used to that.
We're lucky to have you, Harry. You're paving the way for the next folks who are going to walk this path. So appreciate you shaking the tree.
Oh, no problem.
Yeah. Well, I appreciate your time today, both of you, and thank you so much for everything. And I'll be seeing you around real soon. So have a great rest of your day and a great lunch, okay?
For sure.
Take
You
care,
too.
Sarah. Thanks for having us.
Bye, guys. See you soon.
Bye.
Bye.